Hey investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about PayPal. PayPal just reported their Q4 results. I'm going to go through that. I'm going to talk about why the stock is selling off. I'm going to go through my thoughts and what I would be doing if I was a shareholder in this position right now. There's a lot here to talk about. So PayPal has seen its share price slide quite substantially in the past 6 months or so, and after the slide the stock is priced at approximately 6 times forward sales. But as we go through all this, I think that even though this on the surface looks quite cheap, 6 times forward sales, I actually don't see that it being particularly undervalued. So just gonna jump right in if you don't mind. I already alluded to this in the introduction. The stock has been really sliding quite hard in the past 6 months. And it's quite interesting because PayPal is one of the first companies to report that is not a mega cap. We saw last week some stuff, but this is like it's now starting to be in earnest, the kind of moving towards the medium cap companies, and we see this divergence right there between like mega caps. Mega caps have been quite flat, they've actually, some of them appreciated in the last 6 months, but in the case of PayPal, everything started to fall apart when they tried to make the acquisition of Pinterest, and then there was a lot of revolt against that, and the stock slid slightly. And then when they said, okay, actually, whoa, hold up, we're not going to do the acquisition of Pinterest, the stock really didn't recover after that. And now after hours, the stock is down approximately 15%. So there's a lot here to actually justify that sell-off. So if you remember, for the past 2 quarters, PayPal has been downwards revising their guidance, and I said last time that I covered PayPal, I said investors are now starting to think about 2022. How will PayPal come up against its super strong H1 21? So as we see here, on the graph for Q1 2022, they're pointing to be up approximately 6% year over year. Now, before anyone starts pointing, hey, whoa, that doesn't include the eBay, and if we exclude eBay, they're going to be up approximately 14 to 15%. The point stands that this is substantially below what a lot of people were expecting, and that's why the stock is down. But there's more here to think about, right? So one of the things that is puts their near-term prospects into doubt is that you see here net new active accounts. They call these NNAs, if I can pronounce it properly. NNAs kind of trending down. The growth in NNAs of adding new accounts is kind of decelerating. And during the earnings call, they actually said, okay, we're going to see approximately 20 million additions of net new active accounts in 2022 as a whole. So if you think about it, they finished, if memory serves me correctly, they finished 2021 with approximately 426 million net new active accounts. So if they're adding 20, that means approximately 5% year-over-year growth rates in net new active accounts. Okay, so if you rewind this, they're saying, okay, people don't overreact. We're just moving towards engaging these NNAs, these active accounts more, and driving more value. We're no longer driving the number of net new active accounts to accelerate as aggressively as we were. So they actually came out and said, remember that thing that we talked about at the analyst day where we were saying that we're going to reach 750 million of active accounts in the medium term? That aspiration, it doesn't seem appropriate anymore. That's a quote from the earnings call. And it ultimately comes down to this, right? So as an investor, you have a choice, and your choices is to invest alongside high quality businesses that are growing, right? You don't need to go for all just high growth companies, okay? But what you don't want to do is you don't want to be paying a high growth multiple and then end up in a position that the customer acceleration is compressing. And this is what is happening here. So if I've said it before and I say it again, follow the user growth or the customer growth, because that's often more insightful than looking at the revenue growth. Revenue growth can be a bit noisy from quarter to quarter, but if your customer is not coming and just running towards you, you got to take that into consideration. It's a tough investment. There's an investment that makes sense at some price, but you need to know what kind of investment you're getting involved with, because if you're in the wrong side of that investment thesis, it's going to hurt you quite significantly. Moving on. So PayPal says, okay, everyone should just calm down and to think about it, because we are the leading digital wallet. And they show Apple Pay, they show Amazon, they show Google, they show Affirm, they show Afterpay and ShopPay. Now, they haven't put Cash App, Square's Cash App, so that's kind of interesting. But as it stands right now, yes, they are the leader, but does that mean that they're losing market share against the competition? That's, to me, is like, just strikes me as that. Now, here's the thing that is very compelling, and no matter what I've said so far about PayPal, this is the one thing that really, really is bullish about the business, okay? PayPal is guiding for approximately 6 billion of free cash flow. Previously, they'd been guiding to finish 2021 at approximately 5 billion. They actually ultimately ended printing 5.4 billion. So this is a management team that is able to have a strong focus on free cash flow generation. With that in mind, if we say that PayPal is going to report approximately 6.2 to 6.4 billion of free cash flow in 2022, that implies that its free cash flow margin is approximately 21%, okay? So it's, when everything is said and done, this is the figure I want you to take away. I estimate the free cash flow will grow at approximately 14 to 18%, okay, in 2022. So if I just reduce this here, if you have a business where your GAAP operating or your non-GAAP operating margins are compressing, it's going to be quite difficult for you to have such a strong amount of free cash flow generation. So to a certain extent, that's going to be a movement from a positive working capital. But at some point, your ability to squeeze out working capital is going to be, come up against a wall. So you got to think about that. If you have operating margins are consistently compressing and you have the revenue growth that's kind of just dipping down slightly, your ability to generate strong free cash flow is going to be hindered. So it's as simple as that. Just be cautious if you're taking a position here. Now, so this is the one. So when we come to talk about its valuation, it's really kind of difficult because on the back of the analyst day, they were talking about we're going to reach 50 billion in revenues by 2025, okay? We're going to be growing at 20% CAGR from now until 2025. Now, we already know that 2022 is going to be difficult for them and they're going to be growing in the high teens, right? Now, as they approach 2023, they said, okay, everyone don't need to be worried. We're going to reignite our growth rates and we're going to be back to growing at 20%, But as you come up against that, it's going to be tough, it's tough to reignite your growth rate. So particularly if you have fewer net active accounts. So I'm going to kind of put two sides of the equation and kind of let you think how you see this. Now, so if they're no longer able to reach their 2025 targets of 50 billion revenues, that means all the analyst expectations and financial models that there are out there on Bloomberg, etc., they're going to have to be downwards revised. If you hold a stock and it's on the back of a downwards revision from the analyst community, nothing sells better than fear. And I've been in this position countless times and I've been kind of really entrenched and just, I'm not going to give up. But when you get day after day after day of analysts going on whatever financial outlet and saying that the company sucks and blah blah and downwards revising their price targets, it's tough, and you need to know if you're going to have the stamina now to kind of see that all the way through. So as it stands right now, PayPal is priced at approximately 6 times forward sales. Now, if we rewind the clock back a year and you told me you can get a business that's growing at approximately 20%, free cash flow margin 21%, and strong balance sheet, buybacks, management team that's clearly very aligned here. They have founder-led business and stuff like that, and they have a lot of equity in the company, and you're just praying 6 times for sale. Say, okay, I'll take that. That's a steal. But since November, particularly December and early January, we've seen so many high-tech companies really dramatically sell off. So is it really worthwhile paying 6 times forward sales for PayPal when you can get some other really compelling businesses with more visibility and that are growing much faster? Now, it sounds a bit harsh to say this, but in investing, you can either make the numbers or you can make the excuses. And if you don't deliver on the first part, Nobody cares about the second part. And you know, I understand the PayPal has been through a tough period. I get that, right? So, but I've been following this company for a while, and I expected that in Q4 21 they would be out of the woods. And not only is PayPal not out of the woods as it stands right now, but it looks like they're actually getting further into it. And as I said, you know, I don't hold any position here, you know, but I would just say, you know, if I held a position, I'll just bite the bullet here because I think that, you know, it's going to be tough. Now, as I said, you know, a lot of people are going to be coming out and saying, oh, you know, buy the dip, because like they're entrenched and they're fully committed, and you know, like, but I just don't see this as a compelling opportunity. So ultimately, whatever you decide, I wish you good luck. If you want to find out what kind of names I'm particularly bullish about right now and deploying my capital into right now, don't forget to check out my marketplace. It says there right above the screen, deep value returns. Come on board, check out the reviews, see what other people said about the marketplace, start your due diligence there, read some of my other articles, and yeah, have a good luck during the earnings season, and I hope to see you on my marketplace soon. Bye bye.